Actually, I think they blew up because of OnlyFans, because you have all these girls that will put, actually, we're just going to raise like 500K and that's it. And we can do it from just sending an email out. And they raise in like 48 hours. We do not have VCs on our cap table. We have what's called a crowd safe. It is extremely difficult to disintermediate the realtor entirely from the equation.
This is Axiom Alpha, where we talk about building and investing in businesses with unfair competitive advantages. As a real estate investor, I can't tell you how many times I've talked to a real estate agent whose local expertise came from a 4-month-old article that I also read, or how many times I've had agents make typos when filling out the slots in a template contract. I had a highly rated investor-focused real estate brokerage that I worked with one time that literally misspelled my name in a template contract. There's only so many slots available there, and that's a pretty frustrating experience, especially when you're paying thousands of dollars in commission. I ended up usually finding the property myself. I ended up double checking all of the agent's work, negotiating for myself. I still pay a ton of commission, and that's why I find your business model so interesting. So Simple Showing, that's your company. And I want to dig into the business model in more depth later on. But essentially, I think you charge roughly half of a normal commission to either buy or sell a home. Since you guys have started in 2017, how many homes has Simple Showing sold?
A little over 1,000, close to 1,200. When you talk about starting a business, you don't do a lot the first year in terms of revenue. So we really started getting some traction in 2018.
How long did it take to get your first sale?
I would say it took about 2 to 3 months to get the very first listing side, closing, right? We now do both listings and work with buyers and investors as well. But in the very beginning, you're really trying to get a sense of where your value resides, whether it's on the buying side or the selling side. And it was a bit of a circuitous path for us to figure that out. But in the early days, we changed our pricing model probably 2 or 3 times.
Yeah, that was something that I wanted to ask about, actually.
There's been the advent of several other pricing models, either on the buying side and the selling side, over the last few years. And it's interesting to see which ones have legs and which ones get traction, because it is extremely difficult to disintermediate the realtor entirely from the equation. There's certainly some edge cases where it works really well, but that's the trick that I think a lot of people are trying to solve within this sort of prop tech genre. And everyone's trying to solve that at a different angle slightly, right? So ours was, you started out on the buying side. That's what the name came from. And it sort of has evolved to basically a spot where it's actually a pretty even split between our home buyers that we work with and sellers when we do listing. Currently operating in 3 states. We're based in Atlanta, but we operate in Florida and Texas as well. Potential for expansion, but we've been pretty tight in terms of these 3 states over the last year and a half. So another challenge with any startup is you have to manage distractions, and it's really easy to be like, oh, we want to go to New York or California. But that requires capital. You have to take your eye off the ball in terms of things you're doing at home. It's difficult to expand geographically unless you just have a pure play software product. So I do think there's an opportunity for us to expand, hopefully soon, potentially even this year, into a 4th state. But for right now, we're primarily servicing those 3 states.
I'm very curious. I think you raised some venture capital, right? Around $2 million.
Mm-hmm. Yep, 1.8.
You said you've done 1,000 to 1,200 properties sold since 2018. So 5 years, we're assuming like roughly 200 properties a year, 300 maybe if you're accelerating.
Yeah.
If you are making 5,000, let's say on average from those, right, then you're making maybe a bit over $1 million or $2 million at most, I would guess, revenue range.
Yeah, your math's not far off, right? Back of the napkin math isn't far off. There's unfortunately a bit of a variance with respect to particularly the buy side transaction. You mentioned that you're in South Florida, right? Well, you could easily encounter a purchase transaction for a primary residence or an investment property or multifamily even that's $1.5, $2 million, and that would not be a outrageously high price. For example, Broward, Dade County, and Palm Beach County, and that's becoming a bit of the norm, even in other parts of South Florida, even some of Central Florida. In Atlanta, it's a bit more linear, a bit more homogenous in terms of the properties that we see. There's not as much luxury properties, is similar in Dallas to where, the average deal size is going to be $500,000, $600,000. So in that situation, yeah, I think you're spot on. You're going to get a $5,000 to $6,000 listing site commission. Obviously, when we work with buyers, we'll make a little bit more because our model there is to give a 1% refund. So, in that situation, we would be, making a 2% commission. So, is roughly double, although that's a bit nuanced too, because without digging too deeply into the splits of what agents make, there's some unique things you can do on the listing side. Even though you're displaying a 1% commission, you can actually structure the deal depending on how you've represented the buy side commission. You could, for example, represent a 275 buy side commission, meaning I'm going to give the buyer agent 2.75%, and I'm only going to give them 3% if they give me a full price offer or above. And in that case, occasionally we will actually charge the seller 1.25. In other words, we will present a 4% total commission. And if they don't hit with a full price offer, then essentially we'll carve out a quarter, percent, 25 basis points on our side, which would result in a 1.25 listing commission. So that's why I say it's a bit nuanced, because you could probably take an average and maybe it's $5,000, $6,000, $7,000. But I do unfortunately have to say that the home values are going up. I anticipate this year with these multiple rate slashes, that is bad for home buyers, but I think it's going to be a bit of a tailwind for agents. And the more that commission goes up and the reward in terms of the commissions that are paid out each year, it attracts more entrants, it attracts more innovators, more startups, et cetera. So that's a good thing for the American consumer. So we welcome startups coming in the market. I think it's a good thing because it makes the consumer more primed to accept new models. So we're stoked when anybody hops in the market in terms of startups, whether they're doing our model or something slightly different.
Yeah, like you said, disintermediating the real estate agent is so tough. And, part of it is the consumer, part of it is real estate, on the one hand, is a relatively simple industry. It doesn't take a genius to make millions of dollars in real estate. On the other hand, real estate as a market structure is incredibly complicated because you have a network of MLSs that have pretty strong network effects. Each MLS has a pretty strong network effect, in terms of listings, but also in terms of many MLSs control the lockboxes. And that can be quite annoying because they control showings, and the Zillow lawsuit that's currently going on against a group of MLSs. So they control how you can book showings. They often control the lockboxes. There's been times when I've tried to get a showing and showed up, my buyer's agent was there, listing agent never sent them the code, couldn't get in. That shouldn't be the case. There should just be a nice electronic system that automatically sends the code if someone books a showing, but no. And unfortunately, all that power is aggregated at the MLS level. That's a hard network effect to contend with when you have an innovative model.
Yeah, you're right. I was going to say, to that point, I mean, imagine if there was a scenario like if you've ever checked into an Airbnb, right? Different use case for sure. But when you go to your Airbnb, at least on the instant check-ins, you show up, you have a code. Typically, maybe it gets delivered on your email or text message or within the Airbnb app or whatever. But it opens at a certain time. Now, granted, you do have to have that digital lockbox technology in place, right? Like at the actual property. And most ordinary homeowners don't have that. Now, granted, I think it's growing in terms of smart home technology and the advent of that, digital door lock on the front door. But that's kind of the dream, right? I mean, imagine that you're just an ordinary consumer and you want to view any property. As long as there's some guardrails in place in terms of, okay, to register to view a property or any property within a platform, maybe you upload your driver's license, or maybe you do a pre-approval letter, something like that is I think a good gate in terms of filtering through, tire kickers. But, hey, you should be able to enter a property just like you do an Airbnb. I mean, you're there for 15 minutes to take a tour. You don't really need a buyer agent babysitting you. That concept of access is core to innovation on residential real estate, particularly on the buying side. So it always kind of tends to circle back to, how does access happen? Talk about thousands, hundreds of thousands of showings that happen every single day. It's waiting to be sort of disrupted.
Yeah, I mean, I would not be surprised if there's a lawsuit in the next couple of years on that grounds, because the zeitgeist is definitely lawsuits against real estate brokerages and MLSs. And the ability to control the lockboxes means If I'm a seller and my selling agent has to use the MLS lockbox, then there's no way for me to get a cheaper price by just directly allowing buyers in, because I would have to do something very circuitous. I would have to advertise that directly because my seller agent has to use an MLS, and not every MLS is like this, but for instance, I think the MLS that I'm currently in the middle of is like this, where they control the lockboxes. So the seller's agent is using an MLS owned lockbox that they lease from the MLS. That's not, a very smart lockbox. And so there's no way for you to innovate there until that is broken, basically,
Yeah, exactly.
which is very unfortunate. I'm curious. So you guys raised venture capital. Obviously, 7 years in, if you raise 2 million, 2 million in revenue is not the goal. So what went wrong? Why aren't you growing as fast as sort of you deserve from the value that you offer?
Well, so as a early founder, I very much viewed the startup world as a binary. You either make it big, meaning you have a multi-million dollar exit, raise a lot of money, or you fail. And that was sort of like my only viewpoint into it. And I think a lot of founders are still like that. But the reality is there's a lot of different outcomes. And we've sort of landed in the middle, but I would say comfortably. And so I wouldn't say what went wrong. I also probably wouldn't say what went right. You have as a startup, you fail, right? Investors lose their money, you lose any money that you have, and not to mention the time investment. And then you have this big outcome where maybe you grow it for 5 or 6 or 7 years and you get acquired. Between that, though, what's in the middle there? Well, closer towards the bottom is what a lot of people would refer to as a lifestyle business. That's very much frowned upon within the startup ecosystem, certainly within the venture-backed startup ecosystem and like the Bay Area type folks. They don't want to give you money and then you subsequently just run the business in perpetuity without a future exit event. So I would say we're a couple steps beyond that lifestyle business because we do still have the open door to the possibility of raising capital. I mean, we have, as I'm sure a lot of startups do that are a bit more mature, have people approach us regularly that say, hey, we'd love to either buy shares or be represented on your cap table for a stellar deal, and basically try to diminish the equity value of the business and contribute or inject capital at that implied rate. But we did a unique thing in of that we took angel money, and then we took from a couple of investors, and then we did crowdfunding. So we do not have VCs on our cap table. We have what's called a crowd safe, which is a fundraising section of it's called Reg CF, Regulation CF, as part of the SEC code for raising capital, that was brought up in the Obama years, which was basically to say that, hey, we're going to provide ordinary consumers a path to safely invest money in private businesses, because investing in private businesses is really not possible unless you're part of a family office and you're investing through a family office or a large hedge fund. So ordinary consumers typically can't invest in startups until that was introduced. So that's actually the mechanism or the style of note that we have, which basically just means that those individuals do not have shares in our company, which means we control the business and really our board controls the business. So that's kind of a cool place to be. Frankly, I didn't really map it out like that on purpose. It's more of like, that's the only place we could get money at the time, frankly. That being said, though, the crowdfunding route did great for us. And it still actually may be something that we pursue again, potentially. The cool thing about where we're at is that typically has been a lot of regional residential startups like us, real estate startups like us. They've sort of consolidated, failed, or been acquired. So now there's really fewer than 10. There's really only like 5 or 6 that are like us. And they're all very much regional. There's one in California, there's one in Seattle, there's one in New York, there's one in Texas. There's not a lot of us, which is good. And I hope that it kind of continues that way. There's a possibility that we can either combine forces or there's some part of a bigger roll-up strategy. So that's what I'm hoping for. But yeah, so that's a long way to answer your question of like, I wouldn't really say that we failed at any spot. I just think it's very much a slog within this industry, and we've carved out a pretty nice spot in terms of where we're at. We're comfortable, and it's hard to get comfortable because most startups have high cash burn and they will never be comfortable until they keep raising money. We don't have to raise money because we're not burning cash. And having worked with startups as part of Republic, which is the crowdfunding platform that we raise through, that's always the trick. Do you have enough runway and foresight to get you to a net neutral revenue position where you don't have any cash burn? And that buys you time where you don't really have to rely on outside investors. I do challenge a lot of people that I meet and talk to that are founders or considering to be founders. Why not start a lifestyle business? Why not start something that can generate an actual profit and still deliver value in some way? And I think it's just difficult to get people to be like, oh, but that's not an outsized return. Like, why am I just going to build a $500,000 business? Like, that could be really good for you or whoever, if you've just on your own or you and two guys build a, $1.5 million business. That's cool. That should be celebrated, I think, a lot more.
I completely agree. I also think there's an interesting dynamic because VCs, they don't just want you to be very big, they want you to grow really fast. So you can go right now onto YouTube and find a Y Combinator video of somebody saying, if you're not growing 1% a week minimum, then you're gonna die. Really, you should be growing 2% a week or more. Well, I mean, that sounds great, but that is extremely hard to do. And most big businesses were not built that way. They didn't necessarily start growing 1% a week in the beginning. So I think there's also an argument for, yeah, start a business that's profitable or at least not hugely unprofitable. It can be a smaller regional company to start with, and you can grow at 20% a year. Grow at 20% a year for 30 years, that's an amazing company. That's not a typical VC company, but that is still double or triple what you're going to get right from the S&P 500. That's still an amazing company. And you had to probably take a lot less risk to get to potentially the same endpoint, which I find quite intriguing.
Absolutely.
What does your cap table look like now? How much did you raise from angels versus crowdfunding?
We raised 1.3 on Republic, which is the platform. Most people have heard of a company called Start Engine, which is also very good. I know some of the folks there, and we considered and actually would still consider raising on Start Engine, but it's very similar to that. But we raised 1.3, something like that, and then another 500 or 600. So I guess it was close to $2 million through two angels. Actually, our very first check was, so I went to undergrad at a very small school in Birmingham, Alabama called Samford University. Very, very unknown. In fact, we call it the Harvard of the South. It's totally not at all, but it's just a tiny little school. But I had a lot of startup friends and folks there in that Birmingham market. So we did like an incubator there, accelerator. And, they give you, I think, a $50,000 check and they get on the cap table. So they're on their cap table. But that's how I met our very first investor, who was very basic white guy named Bill Smith. And if you Google this guy, Bill Smith, and type in Shipped, which was formerly a competitor to Instacart. It's like SHIP, but T at the end. So Ship with a T at the end. And he started Shipped as a 29-year-old, 30-year-old, something like that. I can't remember. And he sold it to Target for like $350 or $400 million because Target wanted to do basically the same as, Instacart, except in-house. So that's who does all of Target's deliveries now throughout the country. But really, really bright. He actually started a real estate startup. That's what he does now is he runs a real estate startup. I mean, it's not a startup. It's like 200 people, but he was our first check, and I think it was $250,000 or $300,000, something like that. So it was a great banner, type of, at least in the Southeast, everyone knew him because it's not California, right? So people in, Atlanta and Nashville and Charlotte, like they knew who this guy was. So that was pretty helpful, and that got our second check from a local angel investor in Atlanta. But yeah, I mean, they're both very pretty hands off actually, which is cool. They can kind of kick in, feedback here and there. It's more like operational discipline and stuff like that. They're not going to hop in there and be like, oh, your React Native code is garbage. Like you got to fix this bug. Like they don't even look at anything on the website. It's more just like they'll kind of challenge you. I might talk to them once a year where they may say like, what's your P&L look like? Those type of things. But it's more executive level. But yeah, everyone else in terms of our investor, they're not on our cap table, which is great. So it's really, other than that, just our early employees and co-founders.
When you say not on your cap table, are all the Reg CF investors in some kind of SPV, or how does that work?
It's not an SPV, it's a promissory note, sort of. But the way the promissory note works is it only converts at a liquidity at at a liquidation event.
Oh, right. You said it was a safe.
Yeah, exactly. That's why they don't get on the cap table until really that happens. Or there's some covenants in there, like for example, if you raise it's like $5 million, whenever you raise actual equity, then there's going to be a valuation of the business. Whenever you do crowdfunding, there's not an actual true valuation. You're raising at a cap. You're setting a cap that they're essentially agreeing to. You're talking about very small investments. Someone putting in $500,000, and frankly, like I hate to say this, but it's sort of like going to Vegas or buying a lottery ticket. Obviously, we think we're way safer than that. We're still operating, but it's kind of like that. You're like, hey, I'm going to make a bet on this company, and most of the people on these platforms like Start Engine and Republic, they'll invest in 10, they'll put $300 here and $500 there, and you can kind of create like a portfolio. I feel like I'm like the pitch man for Republic. I don't, work there, but I'm definitely like an advocate for them. I think it was like Gumroad, which is like a platform for like digital creators, right? Like they raise on there, which there's a few that had very like recognizable names that have raised on there, like much bigger than us.
So when I think of crowdfunding, I always sort of imagined it would be similar to a Kickstarter campaign in terms of, you probably can't just throw something up there and then hope that the algorithm serves it to all the right people who are going to want to invest in you or buy your product. What kind of marketing did you do? How did you actually do a successful, $1.3 million raise?
That I think is it's a good parallel because it is sort of like that. In fact, there are a lot of product oriented raises on Republic. And it's actually, I think, easier for them because they can say like, hey, we're building this portable 3D printer. And if you invest like $2,500, you're going to get the first prototype out the door, like whenever they're available, right? Obviously, we didn't have anything like that. We're just like, hey, we're raising at this valuation. If you believe in the business, invest at this cap, at this valuation for the promise of future equity. I think a lot of the stuff on Kickstarter are more like project oriented. Like here's a project we're starting to build or a product we're considering. Whereas like Republic, it's an actual company, like it's a C corp. I think it actually has to be a C corp because of how the safe is drawn up, right? It can't be like an LLC, and they filter people. You can't just like go on there and raise. You have to like interview, and you have to see 2 years of financials. So it's not like a layup to get in there, I guess is the point.
2 years of financials. So you had to wait 2 years after starting the company before you could raise.
Yeah, we did have 2 years of financial. Now, granted, one of the years was a partial year, but yeah, you have to, I know, have 1 year of GAAP financials. So you have to have audited financials. You can't just like print out your QuickBooks, right? They diligence the business for sure. They're not just letting, Joe Blow on there. But yeah, I think it's a great, mechanism. If you have a good story.
And did you drive, potential investors to Republic through your existing network or, run any sort of marketing campaigns to drum up excitement for that? Or did you purely rely on Republic to, bring in those investors?
Yeah, it's an interesting point because there's a lot of obviously like consumer oriented apps that have a lot of users. There's the one that I'm thinking of right now that I remember that was really good that I think I put in like $200 or something, and it's called Beacons. So if you ever see like on someone's Instagram, I think they blew up because of OnlyFans, because you have these girls that will put their little, you can't put like a link in Instagram. I mean, you could put like one link, right? So they had an app called beacons.ai. They had like 100,000. I'm making this up. I can't remember how much it is, but it was a lot, like a lot of users when they went on there, and they were like, actually, we're just going to raise like 500K and that's it. And we can do it from just sending an email out. And they raised in like 48 hours or like 3 days, which ours took 3 months as a comparison. We had maybe like, 500 people in our CRM at that point. We didn't have a lot of customers, but yeah, we did have a few people that were prior clients that raised. Obviously, I think if you're in a B2B environment, it's a lot harder to do that because you may only have like 20 customers. So yeah, we didn't really do a lot of in-house marketing. It was more get on the platform, and then they put you in some publications, and we think we did a couple podcasts, stuff like that. And then the word gets out. And I think a lot of it is kind of like herd mentality as well, and kind of FOMO, because you see a lot of people that are kind of putting money towards this one campaign. And I think we've benefited from that a little bit at the end because it kind of kept creeping up. And then they're like, oh, the window's closing soon. The raise ends in like 5 days. And so that's always kind of fun to watch because it went from whatever it was, 8 or 900K to like 1 million in like 4 hours or whatever, because it was closing so fast. But as with any startup, it's just important to pursue every path, right? It could be your neighbor, it can be like a former employee or boss, it can be your uncle. And I do think the accelerators and incubators are good. I am a big believer in incubators because they have a built-in system of investors, whether it be micro funds only deploying like $5 million a year, but they're writing these like, three, 400, $500,000 checks. And then they have the big ones, the Sequoias and everybody else too. So you got to like at least apply for that. We did two accelerators.
What was the second accelerator? You said one was through your school that you went to. What was the second?
Yeah. One was called Velocity. It's in Birmingham, Alabama. I don't know what they're doing now, but at the time they're doing, like I said, it was a $50,000 check for, I think it was like 3%. Then we did one called The Wave. And I'm assuming both of those are still around because this was like 3 or 4 years ago, actually 4 years ago. And that was in Tampa Bay in Florida. And that was actually a no equity, but it was also no check. So the one that wrote us a check was like 8 weeks or 10 weeks or something like that. And the other one was only like 6 weeks. So it was a much smaller one. But it was, when I say 6 weeks, it's like every day. Like I moved to Birmingham for 2 months to do the program. But yeah, I think those have kind of evolved a little bit over the last like couple years because now there's so many like niche specific. There's ones that like only do CPG or only do AI or only do prop tech or whatever. And then there's a lot of agnostic, like the tech stars or the 500 startups or whatever, which I think they'll just pretty much take anybody if you got a good business.
So in terms of a good business, you said you would change the business model several times, or you changed the pricing several times. I'm curious how exactly that evolved. I would imagine part of that was due to, determining what is profitable, and part of that is probably what resonates with the customer. A couple years ago, you had a YouTube video that said you had a $5,000 flat fee listing service. And then like a year later, it was like a 1% listing service. And on the buy
Yeah.
side, on Zillow, your website, YouTube, different articles, I saw a couple different things. One was like 1.5% refund. One was a 1.5% refund. But if you do more than 5 showings, it starts going down. One was up to 1% refund. One was like a $5,000 refund, or up to 5,000, or 5,000 plus.
Yeah, I think that's, good kudos on your research actually. But yeah, I think that there's two things happening there. There's the what's your pricing model, and then there's how do you frame it, like what's your narrative on your website and to the general public, right? Because what we discovered is that particularly on the refund, that was the original, one of our core tenets that we, started the company on is like, hey, people need access to properties, and a lot of them, exactly what you said in the beginning, a lot of consumers are doing a lot of the shopping on their own, right? So they're driving around, they're looking on Zillow on their own, and they're spending exponentially more hours. You may spend 4, 5, 6 hours, you may spend 10 hours in a week just looking at Zillow, let alone driving around. And then the agent themselves only spend like 30 minutes with you to unlock the door and walk you through. So the logic and the hypothesis was like, hey, people are doing a lot of this legwork on their own. Let's see if we can get them in the door. Well, the hook there was, well, why? Why would they do it? What's going to get them to use us versus their cousin or their neighbor or their friend they went to college with who's a realtor? So it was, hey, we're going to reward them or credit them with a part of the commission. We're going to reward them by saying, hey, you did a lot of the work. Let's give you some of the commission that's being earned, right? Well, what we discovered, this is from talking to individual interviews with people, just anecdotal, like just sort of, hey, this is what I'm seeing, this is what I'm seeing. And then even like we sent out big surveys even. So we did a variety of different things. And what we learned is that a lot of people don't understand the commission. I would say most people don't. So it's very hard sometimes to convey, hey, you're going to get a 1.5 back, or you're going to get 1% back, because they get those numbers mixed up. They're like, are we talking about like credit card interest rates? Are we talking about like a mortgage rate? Are we talking about a rebate? Like, what is this percent? So it's kind of difficult. So we decided, hey, look, and a lot of our consumer facing material, whether that be collateral or website or landing page or Google search ad or whatever, maybe it makes more sense to connect it to an actual tangible number. So that's what we've have kind of been doing the last couple of years, and saying on average, you're going to get $5,000 back, because back to our original numbers, typically you're going to be seeing a house that's maybe around 500K. Maybe you get one that somebody's buying a 350, someone's buying a 700, but let's just put like a round number. So that's a lot of times how we frame it. In reality, we do offer up to 1.5%, but it's situational. It's for example, new construction. When there are 0 showings, or let's say you have found the house, like you went to an open house by yourself and we never even met you, right? We never unlocked a door. We never did anything in terms of actually doing a showing. In those situations, we do give 1.5% back, assuming there's a 3% buyer agent commission. That's why it's so nuanced, and you're beginning to understand. I mean, you already know, it sounds like, because you understand the space deeply, but there's so many nuances. But that's the kind of situations where they would get a point and a half back. Let's say it's hypothetically a $500,000 house, and it's a new construction property in Orlando. The builder pays this $15,000 commission. Well, we're going to give the buyer $7,500 at closing, and we're going to keep $7,500. That's a good deal for us because we didn't have to go and do anything. Now, granted, there's certainly a lot of like paperwork and things like that, but we didn't have to leave our home. That being said, we do have to have a diminishing refund over time if we're doing a bunch of showings. And that's why the refund does go down. So from that point, assuming you are doing showings, it starts at 1 and then it kind of goes down over time. And obviously there's some agents that kind of play with that. Some of our agents are like, hey, I showed you 11 houses or whatever, but I'm going to leave you in this lower tier because this was really easy and we saw all the houses in one day. So there's definitely situations where, we take one-offs and kind of benefit the buyer and give them a solid by giving them a little bit of a bump on the refund. But overall, I think the important thing to share is that no one else really does this. The concept of a rebate or a refund, and the distinction there is just, are you giving the commission to the buyer at the closing table in terms of it's on their settlement statement, or are you actually kicking them giving them a check after closing? Maybe you mail it to them or whatever. But either way, this was sort of pioneered in the early days by Redfin 15, 20 years ago almost. And they no longer really do that. They no longer really do that refund. So there's only a few of us that are kind of outliers that are doing this type of program. It's a unique approach in terms of making the home more affordable. And really, it's not so much making the home more affordable as it is making it more accessible, because the hardest part for most buyers, particularly younger buyers, is the cash to close, which is basically the down payment plus closing costs, right? So if you're putting the minimum down 3 or 3.5 on an FHA, that could be back to the $500,000 house. That could be 15 grand. Now you also got to pay some closing costs, which are typically going to be at least 1 percentage point, but could be up to 200 basis points. So you're talking about potentially another, let's say $7,000, $8,000, $9,000. So you got to come up with, let's say $23,000, and you just can't scrounge up that much money to buy this house, right? So suddenly we come in and we're like, hey, you no longer have to come to the table with 24 grand. We're going to give you, let's just say hypothetically 8, like that's a big deal to only have to put up 16 instead of 24. And other agents aren't doing that. Other agents are just hanging you out to dry, and they're like, hey, we're going to give you a bottle of wine at closing and a high five. You know what I mean? That's it. So it's obviously like we believe in it deeply and think that it's adding a lot of value, but the delivery of that is complicated because it involves humans, and it's not just something that you can build software around. Unfortunately, I wish it was. If every house in America had a digital lockbox, or to your point around the MLSs, all of those were collapsed under a single universal MLS, and there was standardization around like lockbox technology, then it would be easy to do it. Then almost everyone would be doing it probably. Some form of rebate or, different pricing on the buy side. But until we get to that point, it's very much like herding cats to like get it delivered efficiently and make money and satisfy the buyer at the same time.
I've read a bunch of papers that tried to like study this and figure out like why this is not the case, because as you said, commissions, they kind of should be negotiated or competed more than they are. And there's not a lot of people who are actually doing, rebate commissions. It's weird. What industry is like that where there's not really price competition? You could even look over time, since like 1940, we haven't done anything in terms of lowering commissions. In fact, commissions are slightly higher now than they were back then, which is completely nonsense. You look at the securities industry, it's exactly the opposite. Securities industry went from 1970, between the actual commission and the spread, you're paying about 9% in commissions. Now you're paying zero. I mean, you pay a small amount in spread, so you have pennies, essentially pennies on the trade. And real estate, it's like, well, we went from 5 to 6 to like that plus a little bit more. It's so strange that technology has not really been a force that has driven down commissions. I think part of it probably is the fact that companies with large commissions can afford better advertising. That certainly helps them expand faster. I'm not sure why that is such an overwhelmingly powerful force in real estate versus other industries, but that's certainly part of it. I think another part of it is maybe you just get a bad reputation. Other real estate agents are like, we don't want to deal with this guy because he's lowering his commissions. And so we don't want to. Obviously, one thing, right? If you offer a lower buyer's agent, then that directly harms them. But even if you don't offer a lower buyer's agent, they may still have a bias against you because they're just like, well, we don't want to bring this guy business because then he's going to get more business. And we don't want
Yeah.
commissions to go down. It's a strange world.
It also really is highly influenced by the size of market you're in, because I've worked a few times of some deals in very small Georgia towns, and it is definitely a good old boys network there where you have to certainly be cautious because all the agents do talk, and there's only 200 agents in the town or whatever. But in a place like Miami where you have 8 million, the population is so big, and you have 40,000 realtors, it's just unlikely to even deal with another realtor again for the next probably ever. So I think the important thing that's happening now that's would be interesting to watch is that about a year ago, the MLSs began to display the buy side commission. Now, not all of them, but most of them do, especially in the bigger cities. So if you look in Miami, for example, or in Atlanta where we're at, and in Dallas where we're at, CRMLS, which is California, one of the biggest MLSs in the country, which covers all of Southern California and Central California. Those all do it. And basically you can look on any listing and like on Zillow, for example, and it will show just a little like bullet, right? It's just buyer agent commission, or it may say, buy side commission offered or something like that. And it's usually between 2 and 3%. It could be 2, 2.25, 2.5, 2.75, 3. Occasionally it's over 3, which is rare. But that transparency is the first step, because now imagine if you're in a community in a cookie cutter neighborhood in the suburbs of Atlanta. Imagine if there's 5 or 6 homes that sell in a year and everyone's watching their neighbors, and there's this awareness now of commissions, and Johnny sells his house and he's offering it only a 2% commission to the buyer agent, and it sells in like a week, and let's say it gets full price or something close. Now Jan across the street is going to be like, oh, wait a minute, Johnny only offered 2%. It's that awareness factor that is something that is not typically talked about. Like, oh, hey, what'd you pay the buyer agent? Or what did that buyer agent make? You would never know. And now it's become a lot more obvious. So that's kind of the step one, is that's happened, which is good. And it's not in every city, but it is in the major cities.
I thought that had been around for a while, where they displayed the buyer's agent comp.
Maybe a year and a half. For example, there's an MLS called Stellar, which is in Central Florida. It's actually like the 3rd or 4th biggest MLS in the country. They just started doing it about probably 9 months ago. And we had it in Atlanta before they had it in Central Florida. So every MLS is different. The stuff on Realtor.com and Zillow and Trulia is all being fed by the MLS, right? So the MLS dictates what is displayed. So, I mean, there's another 100 fields that we input when we put a listing in. It just doesn't show up on Zillow. We see it, if I log into the MLS, I can see all the other fields, but we would always have historically, I can look up, of course, any listing in the past, and we can see the buyer agent commission. And frequently we look at that before we show the house. But now the consumer can see it, or like you said, for the last year or so. And that's a good.
Just to clarify, you're saying, so this was information that was available to realtors. It just wasn't available to the consumer?
Oh, yes. You could always see it in the MLS. In the lawsuits, for example, one of the things that benefits us is there's a part of the lawsuit that says that the brokers can no longer train their agents to tell consumers that the buyer agent is free, like that your service is free, which is what they've been saying for 50 years. And people probably still say it, but I think when these lawsuits come through and filter through down to the local broker level, that will go away, which is great, because that's the common thing. You see people on Facebook like, hey, I work for free for you. That's not true. Like, you are getting a commission, and unfortunately it comes from the buyer. It gets it on the settlement statement. Ledger side is on the listing on the seller. The seller has the debit, but it's baked into the price. So in effect, you're paying it. So that was part of the lawsuit, is the DOJ is like, you can't say that you're doing this stuff for free. Like you're getting paid, you know? I think we're in the early innings still of real estate disruption, but the early innings are taking a long time.
I'm curious, going back to your business model. Obviously, you've done quite a bit in terms of trying to disrupt the normal model. You're playing with it to see what resonates with consumers, which messaging is a dollar amount, is a percentage amount. The diminishing refund is pretty interesting, I think, because one of the main costs I would imagine for fulfilling a buyer client is the actual showings. And so that 1.5% that then goes down depending on how many showings you do, I would imagine that at a certain point that would disincentivize a potential buyer.
Yeah. For the most part, it bottoms out at 0.5. So if someone sees an unlimited amount of homes, and trust me, there are situations like that where someone unfortunately looks at 48 properties. I can't remember what the record was, but back in the day, I think it was 2019 or whatever, before the market really heated up, we had one agent that showed someone like 63 houses or something like that over the course of 3 months. I don't know how she kept track. I think she went back into showing time and like ran the report. But even in that situation, that buyer got 0.5%, which is better than zero, right? And I think at that point, you're so connected kind of emotionally with that agent that there's some switching costs, I think, at that point in terms of like, hey, I've built a rapport. They know what I like. And at that point, I would have hoped that you would have at least made one offer. You know, if you haven't made an offer after 40 houses, we probably want you to go work with another agent, frankly, because that's just excessive. And frankly, that's Redfin. I hate to say it, but I've seen people that have used Redfin, not a lot, but they've used Redfin, 15 times and say, hey, we use Redfin. Now we're ready to work with you to get the refund. They have people that are sort of exploiting, arbitraging their model because they're taking advantage essentially of a quote unquote free service because they book through the app, go to the showing, meet Joe Blow. It's probably a different agent the next time. And then when they're actually ready to pull the trigger, now that's kind of obviously a jerk move.
Yeah, I was actually going to ask you about that because I don't know if you lean on this anymore, but I think at least a few years ago you did, and on the actual showing experience as being something that you can just book online quickly, easily, which makes me think very much of Redfin and the people who just use Redfin to see properties without the intention of using them. Have you had that problem? I know one of the reasons that Redfin has that problem is because they don't have any sort of exclusive agreement that has to be signed up front, which I feel like you could do even at a property level. It's just like if we show you a specific property, you have to buy that property with us. Redfin doesn't do that. Do you guys do that, or have you had this problem?
So we don't require anything to be signed. Now, eventually you do sign our refund agreement because that it has to be shared with the lender because they have to know that you are getting commission contribution at closing. But we don't make you sign what's called a buyer broker agreement. And that's what ties you to someone essentially saying like, hey, I'm represented by this person. I make an offer. They're going to get paid a commission. So I think those are going to change a lot in terms of how they're structured and written. We don't have those, not to get into the entire marketing funnel and the strategy, but where a lot of brokers lean in towards, and certainly where we have more recently, is on the listing side. Because if you have someone's listing 3 out of 4 times, if they already own a house, they're probably not going to go from owning to renting. They're going to go from owning and selling to buying another house. So what we've discovered is sellers at the bottom, closer to the bottom of the funnel, right? The marketing funnel. Whereas buyers are more at the top. It's a wider distribution. You may have people that are kind of like, I'm thinking about buying, maybe, but maybe not. Or I'm thinking about buying, but my lease is up in 11 months. Whereas when you're selling, you're truly at the bottom in terms of you're ready to convert, so to speak, as a lead. There's a saying in the industry that says list to last, which is just basically say like, you can't really survive if you don't have listings. It's hard to survive just working on the buy side of the deal. So that's a big part of what we like to do, and where we're not leading first with the showing experience. It's definitely important, but a lot of once someone books on our website and they find one they like I'm going to book a showing for the very first time, a simple showing. Cool. Honestly, after that, for the most part, it becomes manual, meaning that they book the first one. There's a relationship there. Now they become a client, and then they're just like, hey, I just want to go see. They're going to text us a link of the Zillow listing of like, this is the one I want to go see tomorrow. In other words, they don't usually go back through our website. And I think, frankly, that's the same with Redfin. In a lot of situations, I think that they will frequently, once they have someone's name and number or their email, they just go direct, you know. Now, I do think there's possibility for a more anonymous app, and maybe that's what consumers want, to where they don't need a face and name to the person that unlocks the door, particularly maybe the Gen Z generation and the people that are, you know, introverts and they don't really want to talk to you anyway. Maybe, I don't know. And they're just like, hey, I don't care who it is, you know, it could just be a robot, like, and maybe it is just all through an app. But again, a lot of that probably relies someone on smart home technology to actually get inside the property.
That and MLS rules.
Yeah, and that too. Yeah, just death by a thousand cuts. You know, there's just unfortunately not going to be someone that comes in here and just comes up with some MLS killer or some agent killer. Not going to happen. Not in our lifetimes. And maybe not in the next two lifetimes. Unfortunately, I wish there was, but it's just going to have to be a bunch of really nimble, sharp startups.
Network effects are pretty hard to overcome, and MLS is a beast of a network effect.
Yes, yes.
I'm curious on the agent side how your model compares to Redfin. Do you have a traditional split compensation with your agents, or do you employ them and sort of pay them on a per showing basis like Redfin does?
So Redfin's, they have specialization in terms of their roles. And I know this because one of our former agents worked there, actually two, and they have a specialized listing agent. So all they do is listings, and then they have showing agents that all they do is showing, and then they actually have someone that sits in between and writes the offer. So more of a negotiator. Ours really just do all of the above. So a lot more similar with the traditional agent in terms of the role they're playing. We actually pay a split. So we pay a commission, not a salary. We did actually toy with the salary role a little bit for showing agents in the beginning, but just discovered that like incentives and alignment with the customer, it's just better when they're commissioned, frankly. Now, I've debated this with friends. I have a friend that ran Homey, which is a big startup in Salt Lake City. Another one like us. I said there's 6 or 7 of us, you know, and they pay salary and they've done very well. They're bigger than us, but they've also raised, you know, $60 million or whatever. So I believe that it's a better experience in terms of the delivery of service to pay commission. So that's what we do. It is a split, and the splits, you know, everybody splits different, right, across the industry, and ours is varies based on the source of the lead, and that's pretty common. Meaning, if the source is self-sourced, if you source the lead on your own, or a referral or a repeat customer, or you know whatever, then you're going to higher split on that. And you know, we haven't changed that in a while, probably 2.5 years, 3 years, because I think we've kind of hit the sweet spot there. I won't reveal the secret sauce, but
Is the secret sauce the commission split, like the exact number, or is the secret sauce something else?
no, well, no, it's not really. It's not that really much of a secret sauce, but I mean, it's not super far off from other, you know, traditional splits you'll see across the industry. As brokers like a Keller Williams that have really, I think, unfavorable, you know, splits that we would beat, you know, where they just have a 50-50. Like, hey, we give you the lead, we're only going to pay you 50%, you know, but we're not out there paying somebody 99% on their, you know, self-source deal for sure. We wouldn't make any money on it. But no, I think that, you know, we found a sweet spot there. But in terms of secret sauce, our secret sauce is not really that. It's just more of what we're good at. It's a combination of marketing and specifically digital marketing, and building a funnel of both buyers and sellers, and then knowing the specific dirt that we're in. And that's why it's hard to expand, because we do not know the Los Angeles market that well. As much as I would love to be in LA because everyone's moving and leaving California and coming to Florida or Texas, like it's a good market to be in for listings, which is, as I mentioned, something we lean into. So I would love to enter that market, but we don't know that dirt. Now, granted, you could say, oh, I'm going to hire a bunch of agents that are really good. That's a lot different than actually knowing it. And I do intimately know the entire state of Florida and the entire state of Georgia and a good amount of Texas, but we have a broker in Texas, so he knows it better than me. So for us, it's about using technology in a thoughtful way and not having to lean too much on it. We don't depart wildly from how ordinary agents work. Obviously, we have a lot different pricing model, but so that's kind of our mix, I think, in terms of what's made us successful. And for us, the future is just continuing on this track. And yeah, we'd love to have this like massive exit, and hopefully it happens one day. But we're pretty happy in this spot, kind of between a big startup and a lifestyle business that's doing well and not having to like go out and seek capital every 6 months, because I will tell you that is it becomes a full-time job.
So you're at break even or better right now, so either like slightly profitable or
Oh yeah. Oh yeah, yeah. Well, we're definitely better than break even.
what are the unit economics? There was a company door.com that was founded I think around the same time as you guys,
Oh yeah. Well, they're in Dallas.
and they focused on listings. They were like a $5,000 listing fee. They eventually went under, and the founder created a YouTube video that basically dissected why he thought it went wrong.
Oh, really? I got to check that out.
It was basically like CAC. He was saying like, one, referrals are too slow. We were relying on net promoter score, and people only buy a house every 7 to 8 years. It's just too slow. The referral cycle is too long. He also said CAC was too high, cost too much to acquire a customer. How have you guys dealt with that? What is your customer acquisition cost?
Well, here's the thing. That company, I don't, know them intimately, but I know of them because they were in Dallas. And I know a little bit about Dallas. That's a hard nut because that is one of the hottest markets. It's definitely the hottest state in terms of real estate. I would say Florida's number two. And so it's surprising to fail in that market. I mean, I think they raise at least 10 or 15, $20 million. So, these are smart people. I don't know him, but I think he went to Harvard. I mean, he's not a dummy. It's very difficult to rely on outside money because putting a spreadsheet together, I mean, I went to business school, I can put a spreadsheet together that makes everything look really pretty, but actually doing it is extremely hard. And I could see how that would go wrong because the unit economics, once they get out of whack, if you can't fix it, mostly with marketing or firing people, it's hard to get it turned around unless you just go get more money. So, our unit economics, I would say, were negative in the early days, but for the last couple years, it's been quite positive. And I'd say the biggest reason why is because in the early days, we relied very heavily on paid acquisition. And I think a lot of real estate companies still do, frankly. And we still use paid ads for sure. But there was a big change in Facebook where Facebook was a really good generator of leads, but they changed their categories. This is not to go too deep into this, but around the 2020 election leading up to it, what they decided is people were using Facebook ads to influence voters. And so they came up with these they're called special ad groups, and anything political, anything related to banking, loans, credit cards, housing, you're in a special ad group. So basically in Facebook today, and for the last 3 years, you can't, inside the Facebook ad manager, you can eliminate people from your ad audience, right? Which is what everyone was doing. Not just us, but them, I'm sure, and everyone else that's in other spaces, which is basically to say, like, I am going to market to the best part of Atlanta, and then I'm going to purposely exclude the worst parts, right? The more undesirable areas, right? Because I want to list the most expensive houses, and I also want people that are buying in these expensive areas. The last thing I want is people clicking my ad that aren't going to be buying or selling home. So they used to have all kinds of stuff in there. Like, I mean, they still do. You just can't use it in real estate. Like income groups, right? You could target zip codes. You cannot target zip codes specific to housing and like I said, banking, some of that. Can't target zip codes. You can't target gender. We can't target, for example, a house mom that's shopping for new. Can't do that. I mean, you can write an ad, but there's not a way to find them anymore. So that changed a lot. And I'm not saying that's why I went into business. I'm just saying, if you look back to us, we relied heavily on Facebook and on paid search. So you were acquiring a lead for, I don't know, $40. I'm talking about an email, not a conversion. So that's just an email. Then you have to convert the lead, right, to a listing or to a buyer, to a closed transaction. That's way more expensive. So what I think I would attribute our shift to, this will be, see who can pick up on this, who's in the startup world, but is we shifted probably a couple years ago to SEO and to organic search, not paid search. That being said, I think it's extremely difficult to rely purely on organic. So, as any marketer will tell you, any full stack marketer will tell you, you have to have multiple arrows in your quiver. You have to have a full toolbox. So we do lean more heavily now on organic search. It's just obviously way more economical. So we probably get 60, 70,000, 80,000 visitors to our website every month. Most all of that, 90% of that or 80% of that probably is organic search. Right? So it's not a paid click. That's extremely difficult to build. You have to do that for multiple years. You can't just like, oh, I'm going to start like a website and get a bunch of traffic. Like it's just very hard to do. So it took us a long time to do that. And that's one of the reasons that brought our CAC down. And the other one, frankly, is that you have to be involved in the customer facing things. And that's what I do. And my other co-founder did as well, which basically means that I will occasionally do deals, which means I will take a listing. Now, I'm not taking them every week, but like I will periodically do showings for a buyer. And I don't know for sure, but my guess is that like I'm not doing a postmortem on door because I don't know anything about their business, but my intuition tells me that like he's probably working on spreadsheets and in the back office. And I'm sure, he's probably way smarter than me, but he may not have been doing any showings or doing listings. And sometimes you have to get in there, whether that be just to learn about the business or just like you need to get in there just to contribute revenue. There was another business called Home Bay that was in California that was pretty big, and they went out of business in a very similar model to Door and to us. And it was when the founders, who another very bright individual from a tech background and I think another business school guy, became a broker, started the company, did really well, contributed deals, was in the nitty gritty, built the company up, and then they sold it to like hedge fund or whatever. I can't remember who it was. And then over the course of like the next year or two, it just like tanked. And it was because, I mean, I'm guessing like that guy was like in it. That's hard for, I think, a lot of founders to be that utility player and contribute revenue when it's so easy to just hide behind either the code, if you're an engineer, or a spreadsheet, if you're a finance guy. You have to really wear a lot of hats in the early days.
I appreciate you coming on. This has been awesome.
Enjoyed it, man. Don't be a stranger. I'm going to definitely check out the one with the MLS disruptor. That'd be really cool. The one that we chatted on Twitter about. Excited to hear that one.